One of the largest positions in my personal portfolio is Microsoft Corporation, stock ticker MSFT, currently trading at $412.92 per share. And if we jump over to my do-it-yourself investor toolkit, let's go ahead and zoom in just a little bit. If we come over here, we can see Microsoft currently makes up around 7.7% of my total portfolio. So other than my dividend ETF SCHD, this is my largest position. So this is a high conviction play. Now over the past year, they've done very well, up around 33.69%. And we can see year to date, Microsoft is currently up around 10%. And just a couple of weeks ago, they actually released their latest quarter's earnings report. So in this video, we're going to be looking at that earnings report, be jumping into the dividend metrics for this company and deciding if it's trading at a good value. So let's go ahead and start digging into it. Now we can see if we scroll down, Q3 GAAP earnings per share for Microsoft came in at $2.94, which was a beat by around 11 cents, and revenue came in at about $61.9 billion, which was a beat by around $1.01 billion. So they saw beats on the top and bottom line. And if we scroll down, we can see revenue in productivity and business processes increased by around 12%, revenue in intelligent cloud saw an increase of around 21%, and revenue in more personal computing increased by around 17%. So there was a lot of growth reported in these business segments. Now, something we have to understand about Microsoft is they basically have tons of tiny little businesses all wrapped up into one giant business that makes up Microsoft, and we can see them here. And what's so impressive about this is that most of these business segments have double-digit growth year over year, which is pretty astounding. For example, look at the percentage changes year over year for a lot of these businesses. We can see 29%, 20%, 23% for Microsoft Cloud revenue. Keep scrolling down, we can see 23% growth for Dynamics 365 revenue and 24% growth for server products and cloud services revenue. So Microsoft is basically a bunch of tiny businesses bundled all into one. Now, if we come down here to the bottom, one of the things you'll notice is gaming revenue came in at 51% and Xbox content and services revenue came in at 62%. So what's the reason behind this massive growth? Well, we have to remember in October, Microsoft closed a massive Activision Blizzard deal that was around $69 billion. And this deal was the company's largest purchase ever. So the company saw a huge spike in revenue coming from gaming revenue and Xbox content. Now, one of the questions we need to answer is how did this affect Microsoft's cash position and balance sheet? Because we have to keep in mind this was a $69 billion acquisition. So using the ticker data function, we want to pull in Microsoft, we want to pull in cash per share, and in this scenario, pull it in for 2017, close the parentheses and hit enter. And we can see in 2017, their cash per share was $17.17. Now, if we go ahead and drag this over again, we can see all this other data will go ahead and load in. And it looks like through 2017 to 2021, cash per share was pretty consistent, but it's actually declined a little bit in 2022 and 2023. Now let's come down here and do the exact same thing for cash and cash equivalents. We'll select Microsoft, cash and cash equivalents, and select 2017 and close our parentheses and hit enter. And we can see in 2017, cash and cash equivalents sat at about $7.6 billion. Now let's go ahead and drag this over as well. And one of the things we'll notice about cash and cash equivalents is it actually saw a big spike up in 2023. It went from around $14 billion all the way up to around $34.7 billion. But here's the thing, if we jump back over to Seeking Alpha, let's go ahead and look at the company's balance sheet for cash and cash equivalents. We can see right here, there's where they were in 2023 that we just saw, $34.7 billion. But if we look at the last report, it's sitting at about $19.6 billion. So there was a pretty large drop in cash and cash equivalents for Microsoft after the Activision Blizzard deal. Now that being said, I don't necessarily think that's a bad thing. The company had been sitting on a pretty large cash pile for a while to deploy. So if we go ahead and jump over to our stock screener tab, let's go ahead and zoom back out, come up here, plug in MSFT and hit enter. And you can see all this data will automatically load in. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials like we just saw, then you can head over to tickerdata.com at the link in the description and also get a 7-day free trial. So let's go ahead and start digging into this breakdown. Now, immediately we can see there's a lot to like about the company. They are doing a great job of growing their revenue per share over the past decade, going from around $9.30 all the way up in 2023 to around $28.46. And the bottom lines have followed as well. We can see massive growth in earnings per share and massive growth in free cash flow per share. We can also see that over the past decade, the company has been buying back shares, going from around 8.3 billion to 2023 around 7.4 billion. So that's a decent amount of shares bought back in just a decade. Now, if we look at the debt to assets, again, this is basically the company's total debt divided by total assets. It kind of gives us an idea of the health of their balance sheet. We can see this ratio has been declining over the past decade, indicating a healthier and healthier balance sheet. So again, even with their decline in cash and cash equivalents, we can see the balance sheet really isn't a concern for me. The company seems to be in a pretty healthy position. And then if we look at the return on invested capital for this company, it's basically telling us when the company invests money into new new projects, how profitable are those projects? And the company has been investing into profitable projects. ROIC in 2021 around 28.7%, 2022 31.8%, and 2023 around 27%. That's a really nice level of return on invested capital. And if we jump over to the profitability and income statement sheet, we can see really nice gross profit ratios, and it's been very consistent over the past decade. And in fact, the gross profit ratio in 2023 was right at 69%, when the 10-year average was about 67.37%. So we've actually even seen some slight increases over the past couple of years. The company is also seeing double-digit revenue growth and net income growth. Now let's go ahead and jump over to our dividend breakdown sheet. We'll come up here, plug in MSFT, and hit enter. And again, thanks to ticker data, all this data will automatically load in. Now, when I say I'm a dividend growth investor, people are surprised that I buy Microsoft stock, because look at the starting dividend yield, sitting at about 0.73%. But as a dividend growth investor, there's something I want to know about my investments. I want to know that they're going to be able to increase the amount they pay out in dividends for a very long time, because the end goal for my personal portfolio is to one day be able to live off dividends. And what I love about Microsoft is they're able to grow free cash flow at such a rapid rate. They can have high dividend increases, and they're very predictable, and I know this will last for a very long time. So for example, look at the yearly dividend payouts for this company over the past decade. 2013, they're paying out around 97 cents per share. Look at it now, around $3 per share. So that's a 10-year dividend CAGR of over 10%, and the 5-year is very close to 10% at about 9.7% as well. And even though they've had high dividend growth, their free cash flow payout ratio has remained relatively low, sitting at about 33.29%. And actually, if we look at the free cash flow payout ratio over time, we can see this is a metric that's been decreasing over time because the free cash flow has been growing at such a rapid rate. So when we look at the free cash flow versus dividends paid out, we can see these blue bar charts are going to be our free cash flow. The red is going to be the amount paid out in dividends by the company. The free cash flow is easily covering those dividend payments. So for example, in 2023, Microsoft generated over $59 billion in free cash flow, and they paid out in dividends around $19.8 billion. So that leaves plenty of free cash flow left over to do things like reinvest back into the business, or buy back shares, or pay down debt, or even attempt mergers and acquisitions, just like we saw them do last year. And so despite the company's low starting dividend yield, this actually looks like a great company to hold in a dividend growth portfolio. If you're someone who doesn't need immediate dividend income and has a longer time horizon, this company will continue to be able to increase their dividend payouts over time. And like we saw on their earnings report, the growth rate this company is seeing in all their business segment is pretty phenomenal. Now let's go ahead and put this growth into perspective. We can see this blue line is going to be total revenue, the red is productivity and business processes, green is intelligent cloud, and purple is more personal computing. Now obviously purple saw a little bit of a dip in Q2 of 2023 and Q3 of 2023, but for the most part, all of these that we just mentioned are going to be above 10 to 15% growth since Q1 of 2021 through Q3 of 2024. This company is still seeing massive growth despite being around for quite some time. We can also see that Microsoft is successfully increasing their cloud provider market share. They've gone from around 15% in Q4 of 2018 to close to now 25% as of their most recent earnings report. That's quite a bit more growth than any of these other companies we see listed right here. Now, with all of that being said, we have to still ask ourselves, is Microsoft trading at a good value at $413.40 per share? I mean, to be fair, they are up around 33.6% in the past year alone, and if we look at the past 5 years, 235%, and in the past 10 years, 937%. So this company has seen massive growth over the past decade. So to answer that question, let's go ahead and jump over to our stock valuation spreadsheet. We'll come up here, plug in MSFT, and hit enter. And again, now that this data has loaded in thanks to ticker data, we'll come down here and look at the beta. Beta is currently sitting at about 0.89, so you should see a little less volatility than that of the market, generally speaking. Now, the first valuation we're going to look at is going to be Graham's valuation. And basically, this values a company based on how much their earnings are projected to grow moving forward. So if we come down here, we can see our estimated earnings per share average. We have about 11.9 plugged in, which is pretty close to being in line with analyst expectations. Now we apply our growth rate projection, and again, I say pretty close to analyst projections of around 17, multiply that by 4.4, which is the average yield of AAA corporate bonds, and then divide by Y, and Y is the current yield on AAA corporate bonds, and at the time of this video, it's sitting at about 5.05, which is still quite a bit higher than it has been on average over the past 5 to 10 years, which will significantly drive down this valuation. We can see it gave us an intrinsic value of about $248.84, so current market conditions with the AAA corporate bonds are really driving down this valuation. And just to put it in perspective pretty quickly, if we bump this down to around 4, we can see the intrinsic value jumps all the way up to $314 per share. If we bump it down to around 3, it jumps up to $418 per share. And 3 is actually a current yield on AAA corporate bonds we had just 3 or 4 years ago. So again, definitely playing a role in this valuation. Now, the next valuation we'll look at is going to be our discounted cash flow analysis. And this is one of the most popular ways to value a stock. And we can see basically what we're doing is we're predicting how much free cash flow the company is going to produce in the future. And to do that, we have to look at the company's historical data, look at analyst projections for growth rates and industry projections as well. And we can see I'm going with a free cash flow growth rate for Microsoft of about 16% moving forward. So I project a 16% free cash flow growth rate, find the present value of those future free cash flows and add them together, add the company's cash and cash equivalents, which again is slightly lower now thanks to that acquisition. We subtract out the total debt to get our equity value, divide by shares outstanding, and we come to a DCF price per share of $355.10. Now, the next valuation we're going to look at is going to be our multiples valuation, and there's no perfect comparable for Microsoft, but we can use some big tech companies. We're taking the company's stock price, dividing by earnings per share to get their price to earnings multiple, divide by that average PE multiple, and multiply by Microsoft's earnings per share, and we come to an intrinsic value of about $402.67. Now, the last valuation we're going to use is going to be our dividend discount model. And basically what we're doing is we're valuing the company based on how much they're paying out in dividends and how much that dividend will increase in the future. So what we can see is our historical dividend payments here and our year-over-year dividend growth rates. Moving forward, I'm projecting a dividend growth rate of about 8.25%, discount rate of 9%, and we come to a dividend discount model price per share of $433. Now, a growth rate of 8.25% is pretty high moving forward, but keep in mind, if we look at the dividend growth rates that we saw earlier, they had a 10-year dividend CAGR of 10% and a 5-year of close to 10%. So I do think that is realistic for this company. So when we jump over to the output tab, we can see the 4 valuations that we used: grams, multiples, DCF, and dividend discount model. And if we average all 4 of those together, we come to an intrinsic value of right at $360 per share, which is actually a little bit lower than the current trading price for this company. So with a 10% margin of safety, we'd come to an acceptable buy price of around $323 to $324 per share. So is this company currently overvalued? It would appear that that could potentially be the case. But to be fair, I would argue Microsoft is a company that trades at a premium. This is one of the highest quality businesses out there. They're seeing very rapid growth in top and bottom lines, rapid free cash flow growth, and it's very predictable and very stable. And that is something investors are willing to pay a premium for. Now, that being said, I personally haven't added shares of Microsoft in quite some time, but keep in mind, I do already have a large position. And while if you're someone looking for immediate dividend income, obviously Microsoft probably isn't the best option for you, but if you're a dividend growth investor with a long time horizon, you could potentially see massive dividend growth by buying into this company. So again, at current prices, I don't actually plan on adding any Microsoft to my portfolio right now, but I will happily reinvest my dividends back into this company. But there you go, there is an analysis on Microsoft stock. Go ahead and let me know what you think on this company in the comments down below. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com and get a free trial. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.